All right, ladies and gentlemen, we will now proceed into the panel discussion. If you would like to post a question, you may use the Q&A function in session 1 on the agenda in the ACES app. It is now my pleasure to invite the following panelists on stage. Mr. Jun Wei Ong, Vice President, Asia Private Credit, Allianz Global Investors. Ms. Diana Parusheva, Lowery Managing Director, Head of Public Policy and Sustainable Finance, Asia Securities Industry and Financial Markets Association. Mr. Frank Phuan, CEO, Equator Renewables Asia. Mr. Fabian Davola, Head of Renewable Energy APAC, Nuveen Infrastructure. We would now like to invite our moderator, Mr. Seb Henbest, Group Head of Climate Transition, HSBC, on stage to moderate the panel discussion. Over to you, Mr. Henbest, all you.
Well, thank you very much, and welcome everyone to the first panel of the day. And it's my great pleasure to be able to moderate what I hope is going to be a terrific discussion on financing Asia's energy revolution from risk to returns, unlocking the $3 trillion opportunity. As we were just told, there will be an opportunity, hopefully, towards the end for some questions. And so I believe in the event app, you can submit those. And I have an iPad here where they will come up. So please do have a think about questions as we go along, and hopefully we'll have some time at the end to address those. Before we get going, I want to give each one of the panelists just a couple of moments to introduce themselves and their company and what they do before we get into the swing of things. So we're going to work just down the list. So Fabian, starting with you.
Thank you. I'm Fabian Davola. I'm heading the Renewable Energy APAC team for Nuveen Infrastructure. I've been in this position for 4 years. I've been in Asia for more than 15 years now, always investing in renewable energy projects and developing renewable energy projects. Before that, I spent 10 years with Merrill Lynch in London.
Good morning. This is the 12th year for SEU, but this is my first time attending SEU as or ACES as Equator Renewable. So many of you will probably know the company I founded previously, Sunseap. It was sold to EDPR. So I founded Equator Renewables. Again, I think primarily we are focusing on cross-border renewable energy projects, in particular the Indonesia to Singapore one. And we are also looking into green hydrogen delivery.
I'm Diana Parusheva. I represent SIFMA, the Asian Security Industry and Financial Market Association. We are a member association representing over 60 multinational banks operating in Asia, over 40 asset management groups, and various other financial sector operators. I lead the sustainable finance practice for SIFMA, so I'm very pleased and honored to be with you today.
Morning, everyone. My name is Jun Wei. I'm a portfolio manager with the Asia Private Credit team at Allianz Global Investors. Our team was established in 2018, so we have been actively investing in the region for more than 7 years now. We manage 2 strategies currently. The first one is our flagship secured lending strategy, where we manage $1.4 billion in AUM and have the ability to basically invest across the capital structure. The second strategy is what we call the Asia Infrastructure Credit Strategy, where we now have a dedicated pool of capital to basically invest into energy and infrastructure-related assets, of which energy transition is one of the core verticals that we are keenly exploring. So myself, I cover Southeast Asia. Very happy to be here today and look forward to the discussion.
Fabulous. Thank you very much. So we're going to start by talking a little bit about the current state of play before thinking about where to from here. And I want to start with a question for Diana. There are many countries in the region who have set targets, renewable energy ambitions. We know that across Asia Pacific, all over, a very large amount of capital is flowing, as much as the rest of the world combined almost, certainly as much as Europe and the US combined. But that's not universally distributed. And if we take China out of the picture, that story looks far less rosy. So in terms of the amount of capital flowing to the Asia Pacific and Southeast Asia in particular. Is there enough? And if not, what are the barriers to getting more capital flowing?
Well, that's a good question, and the main question actually is there enough money coming into the right projects? Are they going in the right locations? And overall, are we contributing where we should in order for us to transition? You're absolutely right. The money flow is not distributed equally, but before we address why this might be the case, I think it's fair to say that we have been through a tremendous journey. And if you look at what was the state of play 5 or even 3 or 2 years ago, we collectively developed a lot in terms of our thinking, but also in terms of where money are going. So because we work with a lot of industry players, a lot of regulators and government authorities, we've seen the change of thinking. So if 2 years ago there wasn't a single taxonomy which would look at transition and help you define what transition is, now every second one is either including the transition in its scope or is thinking of expanding in transition. We're seeing more and more green and transition bonds being issued as well. I believe today there is or there will be an announcement of something happening in Singapore. So we have evolved a lot, but you're right, there's still hurdles and there's still problems why transition transition finance is not flowing as free as we would like to. And I will address this question through the general policy and framework perspective, because I believe my colleagues would be able to speak with regard to particular projects and business opportunities. So when you look at the policy landscape, it's very patchy, actually, despite the fact that everybody agrees that transition is the way forward and green has limited role to play, very important, but more aspirational versus what you can do right now. There's still a lot of diverse view of how transition should be defined. I just mentioned taxonomies, and if you look at how transition is defined across different jurisdictions, you see a lot of differences. So we spoke a few minutes ago, are we talking about label transition? Are we talking about generally, broadly transition? Are we talking about your firm understanding of transition? Are we talking about the regulators and the governments and the public understanding of transition? So we're still in a very kind of exploratory phase, and I think there are things that are still conceptually difficult to handle. You know, we are in Singapore. Singapore has been pioneering various pilot projects to understand how and to help industry experiment with some of these opportunities. One of them being the idea of transition carbon credits and how they can assist early decommissioning of coal power stations. So there's a lot still to be understood from a commercial, technological, and policy standpoint. So a lot of challenges, but I think we're on a good trajectory, and there is a firm understanding that transition is the thing that we have to focus on right now.
Well, let's move from sort of that overarching policy, regulatory set of questions to the more commercial and sort of the business opportunity side of it. And with that backdrop, can I come to Fabian and then to Jun Wei? My question really is about the appetite that each of you have for clean energy projects in the region. And because it is not a uniform place, that's going to manifest in different ways for different countries. Like, where looks attractive and why when you answer that? So Fabian, starting with you.
Well, we are structured as a fund, right? So I'll talk a little bit about the investors' appetite for the different countries. We have US, European, and Asian investors. When it comes to US and European investors, they have an allocation for OECD and non-OECD countries. And the allocation for OECD countries is much larger than for non-OECD countries. So the key focus in Asia for this type of investors is in countries like Korea, Japan, and Australia, which are well-developed markets, larger markets, and since renewable energy is a boots on the ground strategy, it makes it more economical to focus on these countries. However, when we look at Asian investors, in particular investors from Hong Kong, Singapore, or Malaysia, there's a lot more appetite for non-OECD countries. They're a lot more familiar, they feel more comfortable. So that's the main difference. When it comes to non-OECD countries, the country that's taking the most attention is India because of its scale and its fast deployment of renewables. I must say that it doesn't come without its challenges and risks, but if you get your strategy right there, the reward can be potentially huge. When it comes to developed markets, we've seen recently more interested in Australia, in particular after what has been happening in the renewable energy market in the US. And in particular, we like a lot the storage story in Australia. There's a number of specific characteristics of the Australian energy market that makes storage particularly attractive.
Just to dig down a little bit more on the why there, without going into the full technical details of energy storage in any particular market, because we can go down a rabbit hole. But between sort of non-OECD, India, OECD Australia, from your perspective, what makes those places so interesting? Is it the project pipeline? Is it the regulatory environment? Is it everything coming together in the right way?
Well, in Australia, we have seen a big takeoff with the Albanese administration, right? Since they took off, they have been fully supporting renewables, which was not the case before. And in particular, when it comes to storage, that market is a very high volatility, is an energy-only market. Prices, the cap of electricity prices are very high, and there's a very fast retirement of coal plants, and there is no nuclear in Australia, and there's not going to be nuclear. So all of that coal retirement has to be replaced mainly with renewables, although gas is going to participate as well, and that's going to require a significant amount of storage.
Jun Wei, same high-level question to you. What's particularly interesting across the region, the OECD and non-OECD?
Sure. So I think energy transition is a core part of what we do in our Asia infrastructure credit strategy. And we have seen a lot of investor interest in assets within this space, in particular recently. So fundamentally, I think investors are increasingly thinking of energy transition as a form of long-duration, yield-oriented asset class. And we think investors' appetite are strongest in markets where there are policy clarity, there are bankable structures, and there are established operating track records. Because from our own experience, these are the most effective factors in mitigating ability to pay risk. From an AGI standpoint, we are quite focused on our core markets of India and Southeast Asia, where India presents a more immediate set of energy transition opportunities that you can tap on. And then you have Southeast Asia, which is a slightly different story, where we think of it as a more long-term secular growth opportunity that we are looking at this point in time. So for India, I don't personally cover it myself, my colleagues do, but I can speak to some of the sort of market dynamics and trends in this particular space. So India, I think just given the sheer scale and depth of the market, it is a very attractive starting point. And I think the policy clarity there is also very good in the sense that you've got very strong commitment, which is also very consistent from the government, in a way where the country is targeting north of 500 gigawatts of non-fossil fuel capacity by 2030, with a commensurate planned investment and grid modernization to match that level of capacity build out. And the reason why India is an attractive market for renewables from a commercial standpoint is really down to a couple of factors. First, you have got very long-term PPAs with credit-worthy off-takers like central government agencies. You have got bankable PPA structures wherein you enjoy the benefit of sovereign-backed payment security mechanisms, which effectively de-risk the payments to renewable developers. And then finally, you have very predictable and clear procurement frameworks, and that goes a long way towards helping investors underwrite the cash flow profile of your underlying portfolio of projects. So when you put all of this together with the fact that if you look at the broader power sector in India as a whole, of which renewables is a subcategory of that, the power sector still faces pretty tight bank lending limits due to legacy thermal power exposures. And the outcome of all of this is that you find that non-bank sources of capital, like private credit, end up financing renewable projects in this market to the tune of 70 to 75%. So that is on India, and we have found ourselves quite busy in this particular market over the last couple of years, where we are involved in various types of situations. For instance, we have looked at transition capital as a bridge to more stable long-term capital structures. We have also looked at providing non-dilutive growth capital to corporates to sort of build out their portfolio and capacity. And then moving on to Southeast Asia, it's a lot more of a different and more nuanced story. On one hand, we have got very strong markets like Thailand and Philippines. We have got mature and established PPA structures that are very bankable. But the ironic thing about it is this very bankability that makes it a little bit difficult for private credit capital providers to play in this space, because the banks are very willing to lend up to pretty aggressive leverage levels just simply because the local system is flush with so much liquidity for the sector. So that sort of carve out subordinated capital players like us who can play at a reasonable price points. So from our perspective, when it comes to Southeast Asia, we think Vietnam actually offers the largest private credit opportunity when it comes to financing energy transition, albeit on a more longer-term perspective. Well, first of all, if you look at the market, it's the largest renewables market in this region by the wide margin. I think the government has set very aggressive commitment to renewables capacity build-out, which is a fantastic starting point. But fundamentally, we are private credit investors, and we got to look at things from a commercial lens. So from that perspective, I think the main issue that we are concerned with Vietnam now is more of bankability, wherein you have grid and transmission infrastructure constraints that effectively results in curtailment of operational projects and difficulty in procuring new pipeline projects. But having said that, we remain very constructive on this market over the long term. We think that Vietnam is in a position where India was at probably more than a decade ago, where you see the situation of a grid congestion due to a massive renewables build-up in capacity. And India has shown us, what's the best way to address this, which is to have a very coordinated investment into transmission infrastructure. And thereafter, you enable the market to sort of scale significantly. So we think Vietnam will broadly walk the same path as India, as what India did in the last decade. And we are continuously monitoring this market, and we are positioned for it over the longer term horizon.
Okay, so there's lots and lots to unpack there, and we'll come back to some of those points you made shortly. But before we do, I want to turn to Frank. We talked a little bit through that discussion there about government commitments, government mandates, and I think most folks in the room will be aware that there's been some momentum building in the ASEAN region for the ASEAN power grid, sort of a grand project idea. And you're actually starting to do this, right? Currently developing a solar project to export clean energy from Indonesia to Singapore. So talk to us about that, and more generally, please, about sort of cross-border opportunities through this part of Asia.
Sure. I think this is probably my 4th year looking into the development of this Indonesia-Singapore project, right? And then I'm sure that you can see that there is massive opportunity there because when we combine the various developers, not just Equator, but the rest of the awardees of the conditional license and conditional approvals in Indonesia alone, we're talking about more than 20 gigawatts, right, of solar power being installed. And we are talking about also gigawatts of batteries, right, BSS systems to be installed in Indonesia for that load factor to be delivered into Singapore. So bear in mind today, Indonesia has less than 1 gigawatt, right? It's hard to imagine that, but Singapore, on the contrary, being a small country, we have 3 times the solar capacity of Indonesia today. But the president of Indonesia has announced a 100 gigawatt program, right? So I believe, how do you get from 1 gigawatt to 100 gigawatt? I think this cross-border opportunity, being able to deliver more than 20 gigs, will surely help to develop the ecosystem, right, in Indonesia to allow for the 100 gigawatt to be developed. So really, I think is really I see it as a very much untapped market in Indonesia. Yeah.
Let's, beyond the Indonesia market, talk to me a bit about sort of the broader opportunity for that cross-border, because I think that when we think about that ASEAN sort of grid idea, it's not just Indonesia and Singapore, it's a much broader set of countries all contributing to energy security and low-cost energy, you know, over the next decades. How do you see it playing out?
I see, I mean, basically you're talking about the Asia power grid, or ASEAN power grid, right? So as Minister Gan this morning has talked about it as well, we have been looking at it more than 30 years, right? So really looking at Singapore being the demand center for green energy, that spurs and accelerate the entire development of this APG. I believe the price point that the Singapore off-takers are willing to off-take at the long term, with a long-term off-take, is also essential for the bankability, right? So looking at, for example, back to Indonesia, where the power price is typically subsidized, right? And therefore, it's hard to meet the expected returns for typical developers in Indonesia. However, if you extend it cross-border into Singapore, having the entire project off-take at Singapore dollars, then having mid-teens returns, equity returns, becomes possible. All right. So I think that itself highlights the opportunity. Other than Indonesia, I see other cross-border between Malaysia and Singapore encouraging development as well. We already have a trial for the LTMS. We also have trials between Malaysia and Singapore for energy electricity trading. I think the extra 2 gigawatt interconnect will surely spur the entire development. I wonder how the Malaysia single buyer monopolistic market, how that would play out with the energy trading with Singapore, right? Because I think the trial itself do highlight the single buyer monopolistic play, right? At being Malaysia, there is an aggregator, and before the energy is being traded with Singapore. So I think it's important to unlock Malaysia, I feel, right? Once we can identify a trading mechanism clearly with Malaysia, then all the countries up north, right, including Vietnam, we talk about Vietnam, Thailand, Laos, all those countries becomes interesting to explore for cross-border electricity trading.
So we talked a little bit about sort of Indonesia going to 100 gigawatts. Indonesia, of course, is an archipelago of islands. You know, the very nature of renewables is their smaller scale. Talked a little bit about sort of, there is a lot of capital flowing for the right types of projects. I just want to come back to Fabian and Jun Wei on how to approach this, because it seems like there are some real challenges to getting capital to flow in that, you know, within this market. And I think you've both got, you know, an innovative approach or an approach that is working for you. And I think everyone would be very interested to hear about that. So Fabian, starting with you, what's the approach you're actually taking to unlock these opportunities?
Well, for us, we're mainly focused on developed Asia, right? But we face the same challenges when it comes to scale. So in particular, countries like Korea, Japan, Taiwan, but they're not the only ones in Asia, but those are the ones that we are focusing on. Either you have high population density, hilly terrains, grid constraints. So the average size of projects for those countries are very, very small when you compare that to Australia or the US or even some European countries. So you see that 95, in some cases 95, 97% of the projects are 1 to 2, 1 to 3 megawatts. I'm talking about solar now. And there are very, very few utility scale large projects, which are the ones that everybody wants, right? So it makes it particularly hard to scale. In addition to that, there's a lot more capital chasing few large projects. So if you buy projects that ready to build or COD, which is a traditional way that we operate in other regions, then the returns are very low because of that. So on the other hand, if you capture the development premium in these countries is higher than in countries like in general in Europe or the US or in Australia as a result of being on the other side of the trade. So we structure as a fund, it's very hard for us to develop greenfield projects or acquire very early development projects and then take them to ready to build or COD and capture that profit. So the way that we've been gradually shifting from acquiring projects to acquiring development platforms, which eventually will become IPPs. And by doing that, we can bundle early stage development projects together, and we can move those projects along to ready to build and to COD and then under operations. By doing this, there's a number of advantages. First of all, it allows us to invest at scale and deploy capital a lot quicker than if we were to acquire project by project. But also, it allows us to centralize our EPC tenders, for example. It allows us to standardize process and documentation. It allows us to centralize our PPA strategy. And all of that, when you put it together, it leads to a lower LCOE and a higher returns to our investors. So our job is gradually shifting from investing in projects to acquiring these platforms and how we can make them more efficient. And there's a number of ways of doing that.
Excellent. And Jun Wei, you're grappling with a similar set of challenges to get those returns, but a slightly different approach. Talk us through how you're approaching it.
Yeah, sure. So our approach to financing renewable projects or energy transition is really centered around flexibility. So we are in the business of providing bespoke structured capital solutions to our borrowers. So each financing situation is really tailored to the specific needs of the borrower we're looking at, and this is dependent on a combination of different factors. You've got your capital needs of the borrowers, you've got what existing capital structures the borrower currently has. You've got to look at the nature of the underlying assets and the type of cash flow profile that you're ultimately underwriting against. One common issue that we do see in renewable platforms is really that of capital mismatch, where on the one hand, you have traditional project finance debt, which is more, I would say, asset specific. And on the other end of the spectrum, you've got equity capital that can be pretty expensive from a cost of capital standpoint. And at the same time, also dilutive, particularly if you're not of a certain level of scale yet. So where we come in is we basically provide the required growth capital to bridge the gap between these two ends of the spectrum. And the situation that we most commonly find ourselves in, and this is really the sweet spot for us, is to basically lend into the holding company of a renewables platform, which own a diversified portfolio of assets consisting of both operational assets and also a pipeline of construction assets. And the use of proceeds from our HoldCo facility will be used to finance the equity contributions of the borrower to fund the build-out of those pipeline projects. Now, this structure has a twofold benefit. From the borrower perspective, what we are doing is really providing them with non-dilutive growth capital to scale their portfolio without having to raise equity too early. And that's a very important point because the multiple that you get from raising equity at an earlier stage of the business cycle versus when you're of a certain scale can be vastly different. So what we are really doing is providing that transition capital to take the borrower or the company from point A to point B in their growth trajectory or expansion plan, such that they can be valued as an enterprise value of a platform rather than a collection of individual assets. And that creates a lot of value for sort of the borrower and its shareholders. And then secondly, if you look at it from an investor standpoint, where we sit at the holdco, we are structurally subordinated to all of those project finance and senior bank debt that sit at the opco. But that's fine because fundamentally what we are underwriting against is really residual equity value. And the capital that we provide to the platform to grow its capacity will translate into a commensurate increase in this residual equity value that is beneath us. And from a value to loan cover standpoint, we are relatively well protected as the company grows in line with how it expects to do. So that's on platform level financing. There are other approaches that we take. So as a general rule of thumb, we don't necessarily look at financing single asset situations just simply because of the concentration risk involved. But on an opportunistic basis where we do see sort of compelling relative value or risk-adjusted returns in single assets, we have found ourselves coming in and providing that sort of transition capital to bridge to a certain outcome, and that can be in the form of a more long-term stable capital structure through a refi situation or a forward sale agreement, for instance. But typically, to mitigate that concentration risk, we want to be senior secured in the capital structure and also layer in additional layers of sort of credit protections. And this can be in the form of, corporate guarantees and pledge over shares of other material entities in a broader group of Renewables platform. And that's how we get comfortable around the exit risk from this single asset situations. And then finally, you have the last bucket of situation or approach that we take, which is for more mature renewable platforms that are in the later stage of their business cycle, where you've got a more predictable cash flow profile that we can underwrite against. Where we can come in is basically to provide a dividend recap to the borrower or the shareholders who are seeking some form of liquidity from their assets, but they don't necessarily want to sort of liquidate or sell their equity stakes in the platform. So what that does is really to provide that level of required capital to the shareholder, who can then in turn reinvest it into some other clean energy or renewable ventures or simply for other strategic needs that they are looking for. So, I mean, to sum it all up, we are focused on being a versatile capital provider and financing energy transition within the region. And the way that we go about doing this is basically to find creative ways to deploy our capital such that it can be value accretive to the borrowers and at the same time risk appropriate to us as private credit investors. And hopefully this flexibility is something that will play a role in sort of building out the energy transition in Asia.
So again, you covered a lot of ground, but you talked a lot about portfolio and platform, but also single assets. And Frank, before coming back to Diana to comment on a lot of what we've heard, I mean, you're focused on single assets. So, and in the particular case where you're looking between countries, how do you get comfortable with the risk profile of those single assets, considering what we've heard? From your experience, is that a material barrier, or there are just ways to overcome that?
I think it's really down to the structuring, right, of how you handle this so-called single asset project. For us, when we look into the cross-border, we look at it in three segments. There is, of course, the Genco segment that's in Indonesia. there is the transmission company, the Transco, that is connecting Singapore and Indonesia, and there is the import co that is dealing with all the offtakes in Singapore, right? So throughout on the subject on how to de-risk or mitigate the risk, I think we also look at it from 3 phases as well. You have the development stage, which we are in now, and in this stage, I think it's important to be prudent. We have a fairly large development budget, but we are not going to spend it all unless we see clarity and milestones along the way. So, for example, in mid of the year, where you have the Indonesia and the Singapore government signing an MOU, I think that is a significant milestone to allow for all the various developers to start to apply for the export license, right? Without that framework, you don't even know where to start, right? So once we observe that there is the G2G willingness to come together, and then we begin to spend more development. I think, so matching milestones, development milestones versus budget, I think is important in the development stage. The second stage of construction, I think is probably important to identify experienced, well-endowed EPCs, right, to take on the job. For us, we work with, I think, the world best EPC companies, right, which have the proven track record to look at giga-scale projects and gigawatt-hour battery systems that had delivered before. And then, of course, the most important is like the marriage, right? Long-term, 20 years, 30 years post the construction, in the maintenance, operation and maintenance stage. How do you de-risk? I guess really especially on the cross-border side, we work closely with the Indonesian government, making sure that our interests are well aligned. In this particular case, we are not looking at a system to system. There is no PLN grid that's connecting to the Singapore's grid. We are looking at a plant to system instead of a system to system. So, investors usually ask what happens if Indonesian government decided one day to turn off the switch, right? So there is no switch to turn and switch it to supply to the Indonesia, if you are thinking about it. In fact, the project where we are in Riau is further away from Jakarta, right? Much further away from any load. It's much closer to Singapore, right? So, and making sure, I think commercial interest with the government is aligned as well over a long period of time is important to de-risk. So to discourage any form of ideas of turning off the switch, so to speak. Yeah.
So Diana, switching back to you now, you talked at the beginning about how, while maybe not enough capital is yet flowing to meet the ambitions and the commitments in the region, a lot of progress has been made from where we were a few years ago, both on the amount of capital flowing into the transition and also maybe the sort of the definitions of what sustainable finance, transition finance means for the industry, the taxonomies, the standards, the guidelines, the product innovations. We just heard a lot about how, in practice, the practitioners here are deploying capital and finding ways to find value, overcome barriers, etc. What do you think, having taken all that in, is missing from the sustainable finance ecosystem that would really help to unlock capital for transition in the region? Maybe it's government, maybe it's to do with the finance industry itself and how it sets itself up for success here. But what's your take?
Good point. So I think there are various roles that different players can play, including the government, the industry, the developers, and so on. But back to where, if you look at who has been successful, you started with, if we exclude China of this picture, we see the patchwork in Asia. But if you include China and look what China did actually, what India did, what now Indonesia is doing, you can see that there is actually a pattern. When the government applies the whole kind of power of governing and enabling and bringing everybody on board, we know Japan is in a slightly different situation, but the government there also worked very hard to create these transition pathways for different industries. And in this process brought everybody from these industries on board and worked with them to understand, and with the financial sector, how this, the financing of this transition is going to work, where the technological opportunities, and how the industry will actually be able to sustain their market position, yet transition into another way. So I think that's where you probably start answering where the missing pieces are, and you can see from the success stories what people did in order to unlock transition. So I think the bottom line is that within the governmental and policy framework, you can create enough enablers, and we still live in a world that there are bankable and investable projects, which everybody wants, and we have a lot of competition there. But there is a huge pool of not so bankable. And the other panelists talk about risk and how they address risk, which is pretty much how you this risk make these projects more attractive for investors and banks to go into them. So many things can be done there. And if you look at technology, we agree is pretty much available in terms of solar and wind. There are a lot of other new technologies in the pipeline, but these are very much commercialized, and they are able to deliver commercial returns. So the question is, where else is the bottleneck then? Do we have these connectivities between different markets? Do we have, for example, energy systems which allow for spot trading of electricity? So all these things which are little pieces of the puzzle that need to be there at the end for you to make a successful picture. So that's probably a little bit of loose answer to your question, but the truth is there isn't a silver bullet, and there are many things that have to be done for this story to be successful.
And I think that leads us into the final few minutes of the session. I have got a question that's come through that I think was a question I was going to ask anyway. So we're going to kill two birds with one stone. And the question that's come from the audience and the question I was going to ask each one of you, and again, just a short answer on this. You may repeat something you've already said to reiterate it, or it could be something new, which is, and to read the question as written, because it's well articulated. If you could make one bold change to accelerate financing for Asia's energy revolution, what would it be?
So from my perspective, I start first? Thanks. So from my perspective, I would say from a private credit investor standpoint, we would like to see a more established operating track record. So the fundamental issues that we see in some of the markets here are really more of curtailment risk and receivables collection risk. So from that standpoint, if we can have a more established operating track record, we will be able to get more comfortable around the underlying business and the credit, and that would be a fantastic starting point for us to look at financing clean energy build out in the region.
I would accelerate the decommissioning of fossil fuel energy sources, which will stimulate the demand on the other side.
What's your favorite, just to dig into that, what's your preferred mechanism to do that? Do you have a favorite that?
I do not, but I look very much forward to see what the project that MIS is leading on early decommissioning of power plants using transition credits will lead to, because we have to bear in mind that we're also looking for just transition, and we're also looking for people not to be deprived of energy or livelihoods or whatever. So I think we have to be aware of the broader implications of this.
Well, for me, I think it will be regulatory, right, or policy-driven. I would love to see how Singapore government can adopt something that, for example, the Taiwan government has done, right? Mandate companies that has use of large electricity demand, a portion of it to be attributed to green energy, right? So failing to do so, they actually go into a penalty with the government, right? So I think that will really spur a clean energy transition here.
I would say, well, there are countries where you might need more capital, but there are also some countries where you need more projects. We don't have enough projects. So I think that I would say regulatory and market reform, so that we can expand the grid, we can make those development process more straightforward. We can accelerate the implementation of corporate PPAs. That would be very helpful. But in order to have this reform, I think the public sector and the government sector have to work more closer together. I mean, there are countries where that's working well, but there are other countries where there's a lot of room for improvement.
Terrific. So, I mean, we've certainly heard about a lot of financial innovation and approaches that private capital is taking to grasp the opportunity. We've heard a lot about the regulatory environment, the policy environment as a key driver to those projects that ultimately need to be there for the finance industry to come to party. And I think it's probably fair to say that the capital is there when the conditions are right. The world isn't short of capital, it's short of the environments in which that capital can be deployed profitably and responsibly. And everyone here is working on that, so I feel very optimistic having had this conversation. So we're out of time. Thank you all very much for being here for part of this. And please join me in thanking Jun Wei, Diana, Frank, and Fabian for a great discussion. Thank you.
Thank you very much for that very engaging discussion. Can I please have you all stay on stage for a group photo together, standing in the middle right here, right now? So have our speakers and our moderator here. You have to gather at the front of the stage for a group photo. Thank you once again.